What if I told you that the biggest mistake you can make isn't in the next market crash, but because of it? Think about this. Data from Bank of America shows that if you missed only the 10 best days in the stock market each decade, your returns would crater from nearly 15,000% down to just 91%. And guess when those best days almost always happen? Right after the absolute worst days. Everyone's terrified of the next big market crash, but that fear is exactly what could fence you off from the single biggest wealth opportunity of your lifetime. The headlines will scream about losses, your friends will talk about selling, and every instinct in your body will tell you to run for cover. But what if the people who get rich in these moments know a secret? They don't just survive a crash, they use it. In this video, I'm going to show you the simple steps to flip that fear into a massive financial win. I'm not talking about complicated trading or risky bets. I'm talking about a proven playbook that anyone can use to turn a downturn into a life-changing event. So stick with me because what you're about to learn will change how you see the stock market forever. Let's be brutally honest for a minute. When you see your investment portfolio drop 10%, 20%, or even 30%, it feels awful. It's a physical gut punch reaction. Your hard earned money, the money for retirement, for your kids' education, for your future, seems to be evaporating right before your eyes. This isn't just about numbers on a screen, it's deeply emotional. Our brains are literally hardwired to avoid loss. Psychologists call this loss aversion, and studies show the pain of losing is about twice as powerful as the pleasure of gaining. This one powerful bias is why most investors make the biggest mistake during a crash: panic selling. When the market tumbles, the news flips to a sea of red. Experts pop up with dire warnings. You see headlines about billions wiped out. Your social media feed is full of friends freaking out. This creates a powerful social effect called herd mentality. You start thinking, everyone is selling, they must know something I don't. I've got to get out before this whole thing goes to zero. It's a stampede, and your instinct is to run with the herd, but the herd is almost always running off a cliff. They sell when prices are at their lowest, locking in their losses for good. They turn a temporary on paper dip into a real irreversible financial hit. Let me tell you a story about two investors. Let's call them Panic Paul and Calm Claire. Both are diligent savers and have built up a nice $100,000 portfolio in a simple S&P 500 index fund. Then the crash hits. The market drops 30% in just a few weeks. Panic Paul is glued to his screen. He watches his $100,000 shrink to $70,000. He can't sleep. He's drowning in anxiety. The fear becomes unbearable, and he tells himself, I just need to get out. I'll get back in when things calm down. He sells everything, taking a $30,000 loss. His reasoning feels sound. He's stopping the bleeding. He moves his $70,000 to cash and feels a wave of relief. Now, he waits. The market is still a roller coaster. There are sharp drops followed by surprisingly strong rallies. People call them suckers rallies. Paul is confused. He's waiting for a clear, all clear signal that the bottom is in, but that signal never comes. The real market recovery starts fast and furious. Some of the biggest gains happen in the days and weeks right after the bottom. By the time Paul feels safe enough to get back in, prices have already shot past where they were. He not only locked in a $30,000 loss, but he also missed the entire rebound. His attempt to time the market, driven by pure fear, cost him dearly. Now let's look at Calm Claire. She feels the same fear as Paul. Seeing her $100,000 portfolio drop to $70,000 is unsettling. But here's the difference: she has a plan. She understands that market crashes are a normal cyclical part of investing. Since 1950, there have been over a dozen market crashes or major corrections, but every single one has been followed by a recovery that reached even greater heights. She knows selling now would be the worst possible move. So instead of obsessively watching her portfolio, she sticks to her plan. She tunes out the noise. She knows her goal is long term, and this volatility is just a part of the ride. The trap Paul fell into is the single most destructive force in investing. He tried to time the market. It's a fool's errand. You have to be right twice. You have to know the perfect time to sell and the perfect time to buy back in. Nobody can do this consistently, not even the pros. Missing just a few of the market's best days, which are often clustered during these volatile periods, can absolutely cripple your long-term returns. The people who get wiped out in a crash aren't the ones who hold on. They're the ones who sell at the bottom. They let fear write their financial strategy, and that's a recipe for disaster. So if panic selling is the guaranteed way to lose, what's the secret to winning? It all starts with a simple but profound mindset shift. You have to completely reframe what a market crash is. Stop thinking of it as a catastrophe. Start thinking of it as a sale. Seriously, imagine your favorite store suddenly announces a 30% off. Everything must go sale. Do you run away in terror? Do you swear off shopping there forever? Of course not. You'd probably rush over, excited to buy the things you've always wanted at a huge discount. A stock market crash is exactly that. It's a Black Friday sale for world class assets. The best companies on the planet are suddenly available at a deep discount. Their stock prices haven't dropped because the businesses are suddenly 30% worse. They've dropped because of widespread, indiscriminate fear. This is the mindset that separates amateurs from pros. It's the core of one of the most famous investing quotes from Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. During a bull market, when stocks are hitting all time highs and everyone is euphoric, that's when others are greedy. A savvy investor is cautious, but during a market crash, when fear is everywhere and everyone is selling, that is the moment to be greedy. This is when the greatest wealth transfer of a generation happens. Money doesn't just vanish in a crash, it moves from the impatient to the patient. It flows from the hands of panic Pauls into the portfolios of the prepared, the calm Claires. Just look at the history. Every major crash has been a phenomenal buying opportunity in hindsight. If you had invested in the S&P 500 at the bottom of the 2008 financial crisis, you would have seen staggering returns over the next decade. If you bought during the sharp, terrifying COVID crash in March 2020, you would have more than doubled your money in a surprisingly short time. History doesn't just suggest this, it screams it. Bear markets, the downturns, are always followed by bull markets, the periods of growth. And historically, the bull markets last much longer and are far more powerful than the bear markets that came before them. The gains in the recovery dwarf the temporary losses of the crash. This isn't some complicated theory. It's the fundamental engine of long-term wealth creation. Companies innovate, economies grow, and humanity moves forward. The stock market, over the long run, reflects this upward climb. Crashes are just temporary, fear-induced detours. They are the moments where those who understand the game get to load up their shopping carts for the next leg of the journey. The key isn't to predict them, but to be prepared for them. And that preparation is what the rest of this video is all about. We're going to build your personal crash to riches playbook, step by step. All right, you've shifted your mindset. A crash isn't a crisis, it's an opportunity. But an opportunity is useless without a plan. You need an actionable playbook. This is the exact 5-step strategy that will let you not only survive the next crash, but actually thrive in it. Step 1. Fortify your financial foundation, your sleep at night fund. Before you even think about investing a single dollar during a crash, you have to get your financial house in order. This is the most important, most overlooked step. Without it, you'll never have the guts to invest when things get scary. This means 2 things: an emergency fund and minimal high-interest debt. First, your emergency fund. This is 3 to 6 months of essential living expenses stashed in a safe, liquid account like a high-yield savings account. Let's be clear, this is not your investment money. This is your life happens money. This covers your rent, groceries, and car payment if you lose your job. Crashes are often tied to recessions, which means job losses go up. This fund is the firewall that protects your life from your portfolio. It's what gives you the confidence to know that no matter what, your family will be safe. You won't be forced to sell your investments at the absolute worst time. This is your psychological bedrock. It's what lets you be calm Claire, not panic Paul. Second, kill your high interest debt. I'm talking credit cards, personal loans, anything over 8% interest. Think of it this way. Paying off a credit card with a 20% interest rate is like getting a guaranteed, risk-free 20% return on your money. You will not find a better return anywhere. Entering a downturn with expensive debt is like trying to swim in a storm with an anchor tied to your leg. It will drag you under. Once your emergency fund is set and your high-interest debt is gone, you can build up your dry powder. This is cash set aside specifically for investing, separate from your emergency fund. This is your war chest. This is the capital you'll deploy when the big sale begins. Having this cash ready and waiting keeps you from making emotional decisions. When others are panicking, you'll be calmly deploying your dry powder according to a plan. Step 2, build your anti-panic watch list. Okay, your fortress is built. You've got your emergency fund and your dry powder. Now, what do you actually buy? A market crash isn't a license to buy just any stock that's gone down. A lot of junk companies will fall, and for good reason. They might not even survive. Our goal is to buy high-quality assets at a discount. This is where you do your homework before the crash. You need a watch list of investments you want to own for the long haul. When the crash hits, it's too late to start researching. You'll be too emotional, and time is critical. You need to know exactly what you want to buy ahead of time. So what goes on this list? For most people, the answer is simple and incredibly effective. low-cost, broadly diversified index funds and ETFs. An S&P 500 index fund, for instance, gives you a small piece of 500 of the largest, most profitable companies in America. You're basically buying a slice of the entire US economy. A total stock market index fund is even broader. For global reach, you can add an international stock market index fund. Why are these so perfect for this? First, you get instant diversification, spreading your risk across thousands of companies. You're not trying to find the one needle in the haystack, you're buying the whole haystack. Second, they have a proven track record. The market as a whole has always recovered. While a single company can go bankrupt, it's almost unthinkable that all of America's top companies would go to zero. And finally, they are incredibly low cost and simple. You don't need to be a stock picking genius. Your plan is just to buy the market. If you are a more experienced investor, you can add some individual blue chip stocks. Look for companies with strong balance sheets, low debt, and a durable competitive advantage, what Buffett calls a moat. Think about resilient sectors like consumer staples, things people buy no matter what, like toothpaste, healthcare, and utilities. Your watch list should be short and specific. It could be as simple as an S&P 500 ETF, like VOO or IVV, a total stock market ETF like VTI, a total international stock ETF like VXUS. That's it. Now you have a pre-approved shopping list. When the crash comes, there's no hesitation. You know exactly what to buy. Step 3, master the core strategy, dollar cost averaging, DCA. This is the mechanical heart of your whole plan. Dollar cost averaging, DCA, is the most powerful tool for an average investor to systematically turn a market crash into a massive win. It's simple, it's automatic, and it removes the most dangerous thing from the equation: your emotions. So what is it? DCA is just investing a fixed amount of money at regular intervals, no matter what the market is doing. For example, you commit to investing $500 on the first of every month, rain or shine. Here's why this is pure genius during a crash. Let's go back to Calm Claire. The market is falling. On the first of the month, her automatic $500 investment goes through. Let's say her S&P 500 ETF is at $400 a share. Her $500 buys her 1.25 shares. The next month, the panic is worse. The market has fallen further. The ETF is now just $300 a share. Her automatic $500 goes through again. This time, her $500 buys 1.67 shares. The month after, we hit the bottom. Fear is at its absolute peak. The ETF is now on a fire sale at $250 a share. Her automatic $500 executes and she scoops up 2 full shares. See the magic happening here? As the price goes down, her fixed dollar investment automatically buys more shares. She is naturally buying low without even trying. She doesn't have to guess the bottom. The simple, disciplined process forces her to be greedy when others are fearful. Now watch the recovery. The next month, the market rebounds to $320. Her $500 buys 1.56 shares. The month after, it's at $380. And her $500 buys 1.31 shares. Over these 5 months, she invested $2,500 and acquired 7.79 shares. Her average cost per share is about $321. By the end, the market price is already back at $380. Those shares she bought in the depths of the panic are already sitting on big gains. DCA is your best defense against your own emotions. The best way to do it is to set up automatic transfers and investments with your brokerage. Set it, forget it, and let the system do the work. It's like putting your wealth building on autopilot, especially when it matters most. Step 4, supercharge your returns with dry powder deployment. Dollar cost averaging is your baseline, your steady engine. But if you want to truly supercharge your returns, you can combine DCA with the strategic use of that dry powder we talked about. This is a bit more advanced, but the logic is simple. While your regular automatic investments continue, you keep that extra cash reserve ready to pounce during moments of extreme panic. How do you know when? You can't time the exact bottom, so don't even try. Instead, set predefined rules for yourself. For example, I will invest 25% of my dry powder when the S&P 500 is down 20% from its high, the official definition of a bear market. I'll invest another 25% if it drops to 30%, another 25% at a 40% drop, and the last 25% at a 50% drop. The specific rules are up to you. The key is to decide on them in advance when you're calm and rational. Write them down. This mechanical approach stops you from freezing up or getting too clever. Imagine Claire has her regular $500 monthly DCA setup plus $20,000 in dry powder. The market officially drops 20%. The news is awful. But Claire checks her written plan. It says deploy 25%. She calmly makes a $5,000 purchase of her S&P 500 ETF. A month later, the market plunges further, now down 30%. It feels like the world is ending, but her plan is clear. She deploys another $5,000. By doing this, she's making bigger strategic buys at moments of maximum pessimism. She's leaning in harder when the sale gets even bigger. When the market recovers, these larger purchases, made at deeply depressed prices, will act as a massive accelerator for her portfolio. This two-pronged attack, steady automated DCA plus pre-planned strategic cash deployment, is the ultimate wealth building machine during a crash. Hey, just a quick pause. If you're finding this playbook valuable and it's starting to change the way you think, do me a favor and hit that subscribe button. My goal is to break down the clear, actionable financial strategies that wealthy people use and make them accessible to everyone. We're about to get into the final crucial step that can save you thousands in taxes, so you don't want to miss it. All right, let's get back to it. Step 5. Lock in your win with rebalancing and tax loss harvesting. You've weathered the storm. You've been buying through the downturn. Now, as the market recovers, there are two savvy moves you can make to lock in your advantage: rebalancing and tax loss harvesting. First, rebalancing. Let's say your target portfolio is 80% stocks and 20% bonds. During a crash, your stocks will fall hard while your bonds will likely hold their value. Your portfolio might drift to something like 60% stocks and 40% bonds. Rebalancing is simply selling some of what did well, your bonds, and using that money to buy more of what got crushed, your stocks, to get back to your 80-20 target. This is a disciplined, non emotional way to buy low and sell high. It forces you to take profits from winners and reinvest them into the asset that's on sale. It's a powerful contrarian discipline. Next up, tax loss harvesting. This sounds complicated, but the idea is simple and it's one of the biggest silver linings of a downturn. This strategy applies to your taxable brokerage account, not a 401k or IRA. Here's how it works. Let's say you own an investment that has lost money. You can sell it to harvest that capital loss. You can then use that loss to cancel out capital gains from other profitable investments, reducing your tax bill. Even better, if your losses are more than your gains, you can use up to $3,000 of that loss each year to lower your ordinary taxable income, like your salary. For example, you sell an investment for a $10,000 loss. Later, you sell another for a $5,000 gain. You use $5,000 of your loss to completely wipe out the taxes on that gain. You still have a $5,000 loss left. You can use $3,000 of it to reduce your taxable income for the year, and the final $2,000 can be carried forward to future years. The trick is to immediately reinvest the money from the sale into a similar but not substantially identical asset. For instance, sell one S&P 500 ETF and immediately buy a different S&P 500 ETF from another company. You stay in the market for the recovery, but you've banked a valuable tax asset. You are literally turning a temporary loss into a financial gain. So let's bring it all home. The public sees a market crash as a disaster, but you now know the truth. It's one of the greatest wealth building opportunities you'll ever get. While others are hitting the panic button, you'll be executing a calm, rational, and powerful plan. You will have fortified your finances with an emergency fund, giving you the stability to act. You'll have a pre-made watch list, so you know exactly what to buy. You'll use the relentless power of dollar cost averaging to automatically buy more as prices fall. You'll strategically deploy dry powder to capitalize on peak fear. And you'll use smart tactics like rebalancing and tax loss harvesting to lock in your advantages. This isn't about being a genius or timing the market. It's about having a simple, disciplined plan and the courage to follow it when it's hardest to do so. The data is clear. Markets always recover. Declines are temporary, but the wealth built by buying during those declines can last a lifetime. The next time the headlines are screaming and the world feels like it's falling apart, I want you to remember this video. Remember Calm Claire? I want you to smile, take a deep breath, and calmly execute your plan, because you'll know the secret. You'll know that you aren't witnessing the end of your financial journey, but the beginning of your journey to true wealth.